cybersecurity is one of the most resilient industries with an expected 14% annual growth by 2030. Considering the transition to zero trust and the immense potential coming from AI, there are many cybersecurity stocks that can make us money. So, I compared the world's best companies to find the best 5 cybersecurity stocks that you can buy right now. The cybersecurity industry has a unique advantage. The corporate spending isn't optional, so the industry will probably still be around in 50 years. So, there will always be stocks that can make us money, we just need to find them. But to compare these stocks correctly, we need to answer one big question. What metrics does the market use to value these stocks? If we want our analysis to be solid, we need to find the metrics that the market looks at to decide the future stock price. And these metrics are different for different types of companies. For instance, for a mature company like Apple or Microsoft, the dividend yield might be important, but a fast-growing disruptor probably won't offer dividends anytime soon. So, the first and most logical metric is the revenue growth. The market will always reward fast-growing companies with a higher valuation. By looking at the estimated revenue growth for 2024, we can see that the fastest-growing cybersecurity companies are CyberArk with 24%, Zscaler with 25%, CrowdStrike with 28%, Cloudflare with 30%, and SentinelOne with 32%. But besides revenue growth, we also need a metric that shows us how efficiently a company grows. And while the net profit would be our first option, we can't use it here since some of these companies haven't reached GAAP profitability. As a result, I believe it's best to look at how much cash does a company generate. This is important because a company generating free cash flow is self-sustainable and can survive any hardship. And so the best metric becomes the free cash flow as percentage of revenue for the last 12 months. The companies generating the most free cash flow as percentage of revenues are CrowdStrike, Qualys, Palo Alto Networks, Fortinet, and Check Point. However, there's a major issue when dealing with the free cash flow margin that many investors miss. You see, the free cash flow completely ignores the stock-based compensation that companies pay to their management. This can get really bad because if a company uses a lot of stock-based compensation, we as shareholders will be diluted, which means that we own less of the company with the same number of shares because more shares were issued. And here's an example. While Fortinet only paid 5% of its revenue in stock-based compensation, SentinelOne paid significantly more, but this huge difference doesn't appear in the normal calculation of free cash flow. So, to have an accurate view of the real free cash flow that a company generates, we need to subtract the stock-based compensation from the free cash flow and create the adjusted free cash flow margin. Now, when looking at the adjusted free cash flow, we can see that there is a significant difference, as for instance for Zscaler, Okta, or Cloudflare. It seems like they're generating free cash flow, but when subtracting the stock-based compensation, their free cash flow is actually negative.
Man, what?
Next, we can combine the revenue growth and the free cash flow margin by using a software-specific metric called the Rule of 40.
Combination.
This creates a standardized way of comparing these companies and shows that there are 5 companies that are really dominating the cybersecurity space. And starting at number 5 with a Rule of 40 of 37%, we have Qualys. With 12% revenue growth and 25% free cash flow margin, Qualys is a company focused on cloud-based security and compliance. Because of the lower revenue growth, this is a defensive stock that has low volatility and returned 34% year to date. At number 4, we have CrowdStrike. This is honestly my favorite cybersecurity stock. CrowdStrike will do around $3 billion in revenue in 2023, and it is expected to grow 28% in 2024. And moreover, it has a 10% free cash flow margin. The phenomenal growth is because of the expansion of CrowdStrike platform from endpoint security to other complementary areas like identity and log management. The market views that as a positive with a year-to-date return of 60%. At number 3, we have Palo Alto Networks with 19% revenue growth and 23% free cash flow margin. This is a huge company that sells endpoint security and response as well as zero trust network. Although this is a less volatile stock, Palo Alto Networks returned a staggering 70% year to date. At number 2, with 43% Rule of 40, is Check Point, with a revenue growth of only 4%. The Rule of 40 is uplifted by the massive 38% free cash flow margin. Check Point sells endpoint solutions as well as cloud and network security. However, because of the modest growth in the future, the market isn't fond of Check Point with a return of only 7% year to date. Lastly, at number 1, with a phenomenal 53% Rule of 40, is Fortinet. And I know exactly what you're thinking.
Hold up. Wait a minute.
Something ain't right.
Fortinet just had a massive gap down, dropping 20% because of a disappointing forward guidance and a deceleration in growth. So how come you're telling me that this is the best cybersecurity stock? The truth is that the market might have been overly optimistic regarding Fortinet, and when the company cited macroeconomic concerns, the stock crumbled, and as a result, it became significantly cheaper. So it looks like we have the chance to accumulate shares in this great cybersecurity leader, growing 18% with a free cash flow margin of 35% at a lower valuation. And before we see which of these stocks are undervalued by the market, here are all the cybersecurity stocks grouped into 4 main categories by revenue growth and free cash flows. In the top right corner, we can see the true winners like CrowdStrike or Fortinet. These are companies that grow fast and generate real free cash flow. In the lower right corner, we can see the companies growing slower with massive free cash flows, which makes them less risky. On the top left corner, we can see the companies growing fast but without free cash flow, which are usually riskier stocks, while in the bottom left corner, we see the stocks that don't grow rapidly and don't generate free cash flows. These are also really risky. Finally, the last thing that we need to consider is the valuation. This is extremely important as it can show which stocks might be undervalued by the market. By using the enterprise value divided by the next 12 months revenue, I again group these stocks into 4 main categories. Firstly, on the top right corner, we see the stocks with high Rule of 40 but expensive. These are stocks like CrowdStrike or Palo Alto Networks, which have strong competitive advantages. On the bottom right corner, we see companies with high Rule of 40 and cheap valuation, while on the bottom left side we have cheaper stocks with low Rule of 40. Lastly, in the top left corner, we see expensive companies that don't have a high Rule of 40. To sum up, these are just some of the metrics that help you find good companies. Please note that you shouldn't buy these stocks blindly, and you should do further research to understand a company's competitive advantage as well as its risks. I hope this serves you as a starting point for investing in one of the most exciting industries in the world. If you learned anything of value or you want to see some more analysis, please hit that like button and subscribe.